Hello class, we're going to go over some things from chapter 11 together and look at capital gains and losses, that sort of thing. So capital assets, first thing is the definition. The tax law does not tell us what it is, it tells us what it is not. So there's your four things that are not capital assets. Notice especially that anything held for sale, inventory, is never a capital asset. And the depreciable property we use in our trade of business, so machinery, anything we use, and that all kinds of property, real property or personal property, doesn't matter. So those are not capital assets. Those are all business property. Second kind of definition is short-term versus long-term. And notice that it is simple, just more than 1 year. So if it is over 365 days, then it is long-term. Okay, if it's 1 year or less, 365 days exactly or less, it is short-term. So how do we know how long you hold the property? Well, usually it's just when you buy it versus when you sell it. And it's important because how we treat them is very different, long-term and short-term. There are some exceptions or things to the general rule as far as when you buy it versus when you sell it. The holding period of inherited property is always long-term. So when you inherit property from someone who died, you always have a long-term gain or loss when you sell it. Carryover basis generally results in a carryover holding period. If you got basis from someone else in the transaction, and we talked about that in last chapter about getting a gift or things like that, then that will, the time period will also carry over. Okay, so when does that happen? There's 3 times that happens. Uses the previous owner's basis to compute basis in the property. This is the gift scenario. So if someone gives you property and then you have to look at how long you own it. If your basis, and if you go back to our discussion about basis, if your basis is determined from their basis, meaning that the fair market value at the time of the gift was higher than basis, your basis carries over, then your holding period also carries over. So if the donor or the giver has owned that property for 3 years, you then are treated as if you had owned it for 3 years and you have a long-term scenario. If that isn't the case, if your basis was not determined by referring to the other person's basis, then it starts when you get the gift. Okay? Same thing from the spouse. You get carryover basis and therefore you have carryover time frame as well. If the taxpayer allocates part of the basis, this is stock splits or non-taxable stock dividends. When you have stock, you've owned it for 3 years, it splits. Your basis in the new shares is basically an allocation of the basis from the old shares. Thus, your holding period for all those shares includes the 3 years you had the stock before it split. And then if you have a like-kind exchange or some other scenario where you adjust the basis because of a postponed gain. So if you do a like-kind, you have a property, you owned it for 10 years, you do a like-kind exchange for a different property, your time period of owning that different property that's new to you, it includes the time period you own the property you gave up. Okay, so those are your scenarios where you have carryover basis and carryover time period. All right, what do you do if you've got different capital gains and losses? We have to once we know what short-term and long-term is, we divvy up all of our gains and losses to both buckets, if you will. We're going to have the negatives be losses and positives be gains. Always net together short-term and long-term. So you use the short-term against the short-term and long-term against the long-term. So once you have a net short term and a net long term, okay, then you can offset one against the other. You take the lowest of the two and offset it against the other one. All right, that's important because when you end up with a net capital gain, that means a net long-term capital gain. If it's long-term, then you pay tax at a lower rate. The three tax rates are 0, 15, and 20%. Instead of the 7 rates that go all the way up to 37% on ordinary income. That's why this is also important, because it makes a big difference in what tax rate you pay. So the 0% income's up to those levels you see there, which is basically the tax bracket for people who pay 10 and 12%, the regular tax brackets. 15 is from everything above 12 all the way up to 37. And then if you're over into the highest tax bracket, over the 37% up and higher, then you pay at 20%. So 3 net capital gains rates, they are matched up with the regular tax rates, but you can see much lower. So instead of paying 37, you would pay 20. Instead of paying 10 or 12, you pay 0. Instead of paying anywhere from 22 up to 35, you pay 15. Big difference. If there's both a net long-term and net short-term capital gain, your net capital gain is just the long-term, because the short-term is not truly treated as a capital gain. So our example here, we offset the 2,800 against 8,050 because the long-term was higher. We have a net capital gain of 5,250, the long-term part. So how do you calculate your taxes? You literally have to take out the capital gain, calculate your tax on the income that isn't capital gain or qualified dividends. Then you calculate the tax on that capital gain or qualified dividends, and then you add the two numbers together. Okay? So here's an example. Abby has taxable income 2018, 135,000. She's single. There's taxable incomes 15,000. Sorry about the 0 missing there. Net capital gain. Her tax liability is, you take the 15,000 out, you're at 120,000. Calculate the taxes on that like you would normally using the tax rate tables front of the book. And she's in the 24% tax bracket. Then you calculate the tax on just the capital gain. All right, she's above the 0% rate, below the 20% rate, so she's at the 15% of the 15,000 capital gain. So her total tax liability is the tax on her regular income and the tax on the capital gain. Now, if she was higher income, that could be then this would be a different rate, as your calculation here would be different. Now, you could be on the edge of a tax bracket and pay part of the capital gain at a lower rate. So if your income, your capital gain made your income go from below the threshold to over the threshold, part of it might be paid at the lower rate and part of it at the higher rate. Okay? So you almost have to treat that capital gain separately and look at it, though, on top of the regular income. Okay, not separately in terms of the total income. Now, what if you have a loss? What if you net everything together and you have a loss? What can you do with that? You can deduct up to $3,000, unless you're married filing separately, as a deduction against ordinary income. So if you had a $40,000 loss, what's going to happen? You're going to end up deducting $3,000 a year for the next several years, because the most you can deduct is $3,000 in any given year. The rest carries forward. It does carry forward forever. It doesn't go away. when you calculate that, short-term capital losses are always used first. And they maintain, if they're short-term, they're when they carry over to the future years, okay, they are either short-term or long-term, the year that, based on the year that they came into existence. So, for example, we got short-term loss, long-term loss. Okay, when we can use 3,000. We utilize 2,500 of the short-term. Always use short-term first. 500 of the long-term. So the carryover is all long-term, right? 6,800, because you use the short-term first. This is all calculated and done on Form 8949 Schedule D. This is where you list the property you're selling, the date of the sale and things, the cost you paid for it, what you sold it for, and then it calculates the gain or loss. You have one of these for short-term capital assets and one for long-term capital assets. Now there's some questions here in the middle about whether or not this was all reported to you on a 1099-B. That's the statement, kind of like a W-2 you get from your employer. If you have a broker, the broker sends you a 1099-B showing you what stocks and other investments you sold during the year and how much you sold them for. Okay, so this is one situation where the general tax rule is when you sell property, you subtract the selling expenses from the proceeds, what you get, in order to calculate the amount realized. This actually, the instructions want you to add your commissions to the cost, and that's how your broker is going to report it, because it's easier for the IRS to verify the final price that way. Okay, and then this is transferred to the Schedule D part for short-term capital gains, and then there's you'll have a second 8949 for long-term transactions. Same questions, whether or not it's reported to you. And then the short term goes to the top part of Schedule D, and the long term, okay, to the bottom part of the Schedule D. All right. And then on the back, there is the calculation of tax. This is where you would net them all together. You calculate your taxes based on your income without the capital gain and with the capital gain. This also is where the carry forward of any losses in excess of 3,000 goes, this last line 21. So that is how the Form 8949 and Schedule D work.